Tom, is a surplus or is the trade deficit between the U.S. and China just widening?
Well, the Chinese would say that they are not focused on a surplus. Of course, we had that deficit in terms of exports for the month of March. What we're looking at in terms of the retail sales numbers, they came in for the month of March pretty strongly, and that was a key takeaway from these figures that we got out this morning. 10.1%. You got, in terms of online retail sales, by the way, year to date, up 35%. So China's consumer is very bullish indeed. Another key takeaway is that private fixed asset investment, that ticked up above state fixed asset investment for the first time in 3 years. That ties into this rebalancing story that we've talked about for some time over China. So other areas that are on the flip side of that in terms of the bit of negativity, industrial production, that missed estimates. You have seen factory gate prices starting to soften, that reflationary trade coming off somewhat, and broadly fixed asset investment missing estimates as well. Overall, though, with this 6.8% GDP print, you've got a window of opportunity still for policymakers here to continue to try to tackle some of those financial risks. The credit environment here, though, is starting to tighten.
Tom, also the other story, of course, that I asked you about, thanks to our wonderful producers over in London, is that China will allow the foreign automakers, Volkswagen, but also Ford, to own more than 50% of local ventures from 2022. This is a huge deal.
This is a significant deal. I think probably longer term for the likes of VW and GM, because these are going to be put in place within about 5 years' time. By the end of this year, the Chinese are saying they're going to allow full ownership for new electric vehicles. So a big win potentially for Tesla. They've been discussing with the Shanghai local government about setting up a factory there. They wanted full ownership. Now maybe they'll get it. It rips up as well this JV structure that's been put in place, 50-50 since 1994. So yes, it's significant and possibly a takeaway for President Trump.
Tom, beneath the radar is an incredible story of how the United States will block a Chinese telephone company, ZTE, from doing business with Americans. And here's the key phrase, folks, around the world. As Bloomberg says this morning, and Tom, also the Financial Times, the real issue here is the linkage of this action by Wilbur Ross and the administration to the other sanctions that have already been put in, the other tariffs that have already been put in. Are they linked?
Absolutely, they're linked. And this question about making it more difficult for Chinese corporates like ZTE, like Huawei, to access US technology, that is the question, that is the issue that makes policymakers here and corporate leaders here sweat when you ask them about it. They are less concerned about tariffs, much more about this, what they see as more protectionist stance. ZTE, its headquarters are standing behind me. They've been banned now from buying chips and modems from the likes of Qualcomm and Intel and Microsoft. It's a huge deal for them, but it speaks to that geopolitical question as well, Tom.
What are you looking for from the government? I mean, this is not the politics and emotion of soybeans in Iowa. This is directly a direct company, directly against technology. And it's remarkable the language of how it's worldwide for U.S. entities. How will China respond?
I think you're going to see a doubling down of their Made in China 2025 program, which gets them to this point where they have their own high-tech industries, like semiconductors. They've been piling in billions of dollars in terms of R&D around semiconductors to try to avoid exactly this kind of scenario. So for many in the Chinese political camp here, they will be pushing for an acceleration of this program, more spending on those types of technologies. Whether or not they've got enough R&D, enough expertise to make that move and close that gap is a question, clearly, that we're going to have to be watching.
Thank you so much, Tom Mackenzie, there, Bloomberg's China correspondent from Beijing. Now, joining us here in the New York set is Neil Shearing. He's the Capital Economics Chief Emerging Markets Economist. Neil, great to have you on the program. I guess the key takeaway from China is, first of all, they are opening to foreign ownerships. GDP was okay, but also they're buying more treasuries. Out of those three stories out today, what do you think is more significant longer term?
I think longer term it's the trade stuff, right? Is this a phony trade war? Is it a real trade war? That's the big question. That's the existential question hanging over the global economy for the next 5-10 years. In the near term, the market's going to focus on that GDP number. Now, I think there's two ways of interpreting that. Either China has successfully abolished the economic cycle and growth is 6.8% forevermore, because every single GDP print for the last 3 years has been in and around that number, or actually the numbers aren't telling us the real story, and I think it's the latter. We have our own measure in capital economics. That suggests growth was actually about 4.8% on the year, which is down from about just over six months ago. So there's actually some evidence that the economy is actually slowing, despite the stability of the official number.